Hello and welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And today on the show, we're talking about should I sell my property? Now, this is a great wee case study of a listener of the show called Rachel. And for any of you guys watching on YouTube, I should just mention, you might be thinking, why am I not in the studio with Andrew? I unfortunately have caught the spicy cough. I finally came down with the Rona.
Got it.
And so I am recording in my hotel room. Luckily, the team left all of the equipment for me. So here we go, because we're committed to doing this. Now, this is a great wee case study from Rachel, who said, not sure who to ask about for this one, looking for some advice. She's purchased a 2-bedroom, 2-bath townhouse based in Christchurch in a suburb called Richmond. Now, she put this under contract and confirmed on it in October last year. It's ready for completion in about June, but now she's getting worried, or at least her significant other is, about all of the news and the internet hype. He wants to sell that property as soon as it's built, wants to put that money into a term deposit, like a 3% term deposit. So she's asked 2 questions. The first is, if I sell this property, will I become a speculator? And we'll talk about what that means in a minute. So will my future capital gains always have to be taxable? Will I have to pay tax on any future capital gains? And also, what would you do? I would keep it, but my other half doesn't. Cheers, Rach. Now, Andrew, kick it off for us. What is a speculator and what does that mean for Rachel?
So a speculator is a person that buys property with the intention, which is the key word, on selling it at a profit. Now, you might be thinking, well, isn't that everyone? Isn't that someone that just buys a property and they're going to sell it in 20 years? Well, no, this is with the immediate intention. So you buy it, you've got a definitive plan to sell that property. Now, those people always need to pay tax on their profits of property trades. But investors are people who primarily buy with the intention of holding for the long term and having a rental income come in. And, you know, obviously we have the bright line test, which captures a property within 10 years, unless it's your own house, or 5 years if it's a new build. So for Rachel, if she sells, does her future profits get taxed? The answer is probably not. She's very unlikely to be caught as a speculator under this. You'd have to show a regular pattern of it before the IRD said, no, this is absolute speculator. In Rachel's case, she absolutely is buying the property with the intention of holding, but she's had a change in circumstance. Husband's got the cold feet.
So let's come across to the more interesting question of whether she should sell or not.
Right, so Rachel, when you bought this property, I'm sure you had the intention of holding it for somewhere between 8 and 10 years' time, or maybe even longer. You bought as a long-term investor, but now you're making a short-term decision to what I call a long-term asset. And look, it sounds like you're trying to maximise your short-term gains. Well, maybe in some ways you're trying to minimise any potential losses rather than looking for the long-term growth. And it's okay to be scared. That is absolutely normal. And I think in a market like this where every second headline is about the market dropping and where's it going to end and is it going to be 20%, is it going to be 10%, what is the drop going to be? It is very normal to get a bit panicky, but I do always say to investors, don't make a short-term decision for a long-term asset because that's how you lose money.
So, Andrew, it sounds like you're leaning more towards keeping that property, but there could be some legitimate reasons for Rachel to sell that property. So let's say there had been a substantial life change. We really needed access to capital within that property. I'm talking about a health scare where you needed to fund some private medical costs or a death in the family and you really needed some access to money. That'd be a situation where you might look to sell a property even if your intention was to hold it for the long term. Similarly, if you were very, very close to retirement and you wanted to preserve the value of your assets, and so you're thinking, well, I can't have the value of my assets drop too much, I need to preserve the value of it. Well, that's when you might look to hold that. But that would usually be in the situation if you'd bought this property with a lot of cash anyway, and there's a substantial amount of equity within the property. Those are some situations where I'd think, okay, maybe it might make sense to sell.
But look, it does sound like these apply to you, so these are my arguments for keeping it. Firstly, the return on term deposit is not great for investors right now who are wanting to build their wealth. So I am making the assumption that you've got, a wee bit of time towards retirement, and so you are wanting to build your wealth, and that's usually what people get into investment property for. So let's say that you clear 100K from your property and you want to invest that into term deposit. Now, if you get a 3% return on that term deposit, remember a percent of that's going to go to tax, so you're down to 2%. So you walk away with $2,000 profit every year for that term deposit. It's not going to be game-changing when that comes in. It's not going to touch the sides of your financial goals, I guess. And remember, the real return on term deposits is negative. So right now, inflation's about 7%. So if you've got a 2% net return and 7% inflation, your real return is actually negative 5%. You're actually going backwards.
Now just walk me through that. So, because I thought she was getting a 3% return from the bank.
Yeah, so 3%, but remember tax is taken off that. So that leaves us with 2%. Now you have to take inflation off because your money is not going to buy as much next year as it is this year. So if we take inflation off the 2%, the net return, that leaves us with negative 5. So your actual ability to purchase next year is $95,000 worth of purchasing power, not the 100,000 that you started with, plus the 2,000 interest.
And I think it's interesting to note that, okay, let's say she bought in October, which was the peak of the market. Actually clearing 100K off that property, if she bought it with 100% debt, may not be realistic either. In fact, there could be a situation where she loses money off that.
Well, let's say you bought it for 650,000 and it's still worth 650 today. Well, once you've paid a real estate agent fee, lawyer's fee, it's going to probably cost you about $32,000. So if you do sell, if you make the decision to sell, if it's not the right thing for you to hold it, Rachel, you're going to crystallize that 32,500 loss, which is not great investing.
And this is usually the case if you are going to buy a property and then sell it immediately and not do anything to it. So yes, there are transaction costs with property, but usually if you've held a property for 10 to 15 years, even longer, then you would have made a substantial gain to cover those costs. And we usually allow for about 5% of the value of the property in order to sell it, once you account for real estate agents, lawyers' fees. So there are some really good reasons not to sell it, especially if you haven't done anything to it and it's got very little equity with it. I also think you should consider what your prospects for selling that property are. So the good news is that this property, because it's going to receive its code compliance certificate this year in 2022, it will be considered a new build for tax purposes. That's a real bonus when you're selling it. It is going to be complete, with new builds. One thing that people often get worried about is if there's a 12 to 18 month horizon between signing up to confirm on that property and the property actually being built. There are people worrying about, well, I'm not going to be able to get the bank financing confirmed at the time when I sign the contract and go unconditional on that property. So, and it's got to be completed. I do see that as a bonus. But I do think you're more likely to sell to an owner-occupier or a first-home buyer rather than an investor. Because the bad news, unfortunately, with this property is that when it comes to the bank reviewing it, it's going to require a 40% deposit because it's going to be an existing property if you settle it. And then if you go ahead and look to sell that property on to the next person. But there are some other things you could do. And I'd just recommend you listen to the podcast we just did on how to get out of an unconditional contract. So I suppose that comes down to the question of should you sell it? And the question I want you to ask yourself is, at the time you purchased it, was it the right investment for you in the first place? Because if it was, and this was a long-term 10-year investment horizon, you plan to hold this property, then I think it's probably the right decision to keep it, because you're probably the sort of person who needs to build their wealth and is over 10 years away from retirement. So you can afford to hold this asset over the long term. You don't need access to that capital straight away. Now, if it wasn't the right fit for you, if you're the sort of person who's close to retirement, you bought it with a whole heap of cash, and actually your primary goal is to preserve your capital, then that could be a reason to get rid of it, because it probably wasn't the right fit for you in the first place, because you're close to retirement and you're already wealthy.
So how do you get your husband on board is the next question, Rachel. Look, I think you both need to be on the same page. Certainly when it comes to investments that involve both of your money, it's really important. Certainly any investor that works with us, we involve both parties in the decision-making process, even if it's just at the start to figure out what the long-term goals and strategies are, because, the property itself can be chosen by one person, but really you both need to be on board with a big financial decision like this. And look, some things that I would do to help your husband get a bit more comfortable with this, because again, it is normal to feel nervous in markets like this. Subscribe to Tony's View on Tony Alexander's website. It's great information, and Tony is the second smartest economist we know. Obviously, this podcast hopefully might help, and maybe just stop reading the news as it relates to property prices at the moment. Look, I very rarely read any of that stuff now because it is sensational headlines to sell newspapers and clickbait. Look, I think that it can be really damaging to your mental frame of mind when you're looking to invest or build your investment portfolio, or even if you've got a portfolio, because people get nervous and suddenly start selling things. So again, don't make a short-term decision on a long-term asset, and hopefully your husband will get a bit more comfortable.
And when you've dealt with investors who are feeling like this in the past, Andrew, where one partner's second guessing it and another partner's gung ho, what do you usually do? What do you recommend to them other than what you've just talked about?
I think the best thing investors can do is work out strategies for how to hold the property, because that's the only thing that really matters. If you hold for the long term, your property is going to go up in value. Well, history would suggest that. And so usually it's just the higher interest rates that might be a bit more of a challenge. And I know we did an episode recently where we talked about some of the ways to combat the increased cost of holding a rental property. Any investor that I'm working with right now that has had that as a concern has got comfortable and said, you know what, we can make some tweaks to our financial commitments right now so that we can hold this property over the next 2 years while rates are higher, and then when things level out, it'll be fine.
Fantastic. Let's wrap it up there, but please don't forget to rate, review, and subscribe to the Property Academy podcast. Really does help us get the message out to more people. And hey, if you are looking for some help, you want to grow your property portfolio in 2022, then whip out your phone and send us a text. Text the word PLAN to 5522, and we'll be in touch to book your complimentary portfolio planning session. Thanks for listening to the Property Academy podcast. I'm your host, Ian McKnight.
And I'm Andrew Nicol.
And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.